Many people approach the stock market like a slot machine, chasing gains while ignoring the credit card debt charging them 22% interest. If your investments are in an average of 10% a year, but your debt is growing at 20%, the math is working against you. The growth of that debt will eventually consume any progress you make in the market. Building wealth requires a rigid order of operations. This is a 5-phase sequence designed to prioritize your financial defense before you ever commit capital to market risk. Skipping these steps creates a structural weakness in your finances. You must establish a protective foundation before you can safely focus on growth. Statistical data shows that 1 in 3 Americans lacks even a basic $500 safety net, leaving them vulnerable to the slightest financial setback. Your first objective is to accumulate a cash buffer of $1,000 to $2,000 as quickly as possible. This fund serves as a firewall. It ensures that when an unexpected expense arrives, you don't have to sell your investments at a loss or rely on high-interest credit cards to stay afloat. This protective reserve acts as a mandatory insurance policy for your portfolio. It prevents a single broken water heater or a surprise medical bill from derailing your entire wealth-building strategy. Phase 2 targets toxic debt. Anything charging more than 8% interest is a liability that uses the power of compounding to actively destroy your net worth. Take a look at Warren Buffett. His historical long-term return is roughly 20%. Pay the minimums on every account, then funnel every available dollar into the balance with the single highest interest rate. Eradicating this debt provides a risk-free return that no market investment can promise. Once these high-interest hurdles are gone, your capital is finally free to work for you. There is one critical exception to the debt-first rule: the employer-workplace retirement match. This diagram shows the mechanics of a match. When you contribute $1, your employer adds a second dollar. That is an immediate, guaranteed 100% return on your money. The strategy here is precise. Contribute exactly enough to capture the full match, then stop. Any remaining cash flow must be redirected back to clearing your Phase 2 debt. Failing to take this match is the same as walking away from a guaranteed cash bonus. It is the only investment that takes priority over paying down debt. With your debt cleared, the focus shifts to tax optimization. Minimizing the amount the government takes from your gains allows your wealth to compound much faster over time. The Individual Retirement Account, or IRA, is your first line of defense. Unlike many corporate 401ks, an IRA allows you to use low-cost index funds that won't bleed your returns through high management fees. However, the Health Savings Account, or HSA, is even more efficient. This diagram illustrates its triple tax advantage. Your contributions are tax-deductible, your growth is tax-free, and for medical expenses, your withdrawals remain tax-free. Utilizing these specific accounts protects your money from tax drag. It allows the full weight of your investments to compound without the IRS taking a cut every year. Only after you have exhausted the limits of your tax-shielded accounts should your wealth overflow into a standard taxable brokerage account. This is the New York Stock Exchange floor, where that unrestricted market access takes place. This account is subject to taxes on dividends and capital gains, but it has no contribution limits. Most importantly, it has no age requirements, meaning you can access this money whenever you choose. This is your bridge fund. It provides the capital needed to sustain you during early retirement, covering the gap before you are legally allowed to withdraw from your Phase 4 retirement accounts. Following this sequence ensures every dollar you earn is deployed to its most efficient use. It replaces the uncertainty of market timing with a prioritized system that builds wealth from the foundation up.